Second aspect of accounts receivables that's really important, it comes down to the actual valuing of the accounts receivables. And this is really important when we're looking at transparency, accuracy, and the balance sheet. Valuing the accounts receivable involves determining the amounts of accounts receivables to report, and this can be difficult because over time some receivables are going to be uncollectible. This creates what we call the bad debt expense, and this is an absolute normal and a necessary risk of doing business on a credit basis. We value our accounts receivables as current assets at what's called net realizable value. So what do you actually really expect to collect? Because there will be some of those accounts receivables that won't be collected. We need to determine what that amount is and recognize it as a bad debt expense in the period in which the sale actually occurred. There are two methods in accounting for uncollectible accounts. Those two methods are the direct write-off and the allowance method. The direct write-off is one that GAAP does not allow us to use. It is theoretically undesirable. There is no matching of expenses and revenues. Receivables aren't stated at their net realizable value on the balance sheet, and we cannot use it for financial reporting. During the direct write-off method, this is when a specific account is determined to be uncollectible and the loss is charged to the bad debt expense at that specific point in time. Some of the challenges of the direct write-off method is that when an account is actually written off, that typically occurs in one accounting period, if not more, following the period of the actual sale. So that matching does not actually occur. It's slightly off scale. This can be a serious problem if we're looking at a time frame, say from December to January or December to the following February, and that is the end of the fiscal year in December. Excuse me. The other method is the allowance method. And this is where we, as managers and accountants, go into some mathematical estimation that is paired with historical experience. It provides better matching of revenues and expenses. Our receivables are then stated at the net realizable value on the balance sheet and is actually the one that is required by GAAP. So let's just take a look at how some of the accounts are presented on the balance sheet. So the accounts that we use when we're dealing with an allowance method is accounts receivable and then a valuation account, which is a contra account, called the allowance for doubtful accounts. It reduces the accounts receivable account without actually having an impact on the individual accounts receivables at the point of estimation. It will have a normal credit balance, and it is presented in this manner. So you see how the accounts receivable amount is off to the left, one column to the left of the totals, and then we see less allowance for doubtful accounts, and then what their difference is, this is what we actually recognize on the balance sheet. Now this can also be done in a single line rather than two, and this is how we would present that. And we would say accounts receivable and the net of whatever the amount of the allowance is. However, we do provide the information of how much the allowance is, and we are required to do that. So using T accounts, we'll look at the accounts receivable side of a journal entry for a credit sale of $100. And then continuing to use T accounts, let's look at a collection of $333. And then let's assume that we are going to go into our estimation period, and we're assuming that there will be $15 of estimated bad debts. We don't know who. We don't know exactly which accounts. We just have an estimation of $15. So we post that over to the allowance account at this point. My apologies. Now, time has gone on, and we actually realize that customer A is not going to pay us $10. We know that it is customer A. So we will write off customer A's account, and we will reduce our allowance for doubtful accounts by $10. Because of that original $40, we've now identified 10 of it. We know customer A is going to not be collectible. After all this has occurred, this is what the balance sheet would look like. Because we would have accounts receivables net of a $30 allowance of $227. Now we're going to talk a little bit about that direct write-off method for uncollectible accounts. Now remember, I said this is not something we can use for financial reporting according to GAAP. However, it is something that you are likely to experience if you are working with a small company who is not subject to GAAP, such as a sole proprietorship. Many of them use the direct write-off method. When we are using the direct write-off method, our bad debt expenses show only the actual losses from those accounts that have been deemed uncollectible. So let's see how that actually works. Ward & Company writes off Doran's $200 balance as uncollectible on December 12th. So they would have a bad debt expense of $200, and then they would go straight to the accounts receivable account for Emmy Doran for $200. Remember that there's no matching. Bad debt expense will show the actual amount of loss that was deemed uncollectible in that period. This can happen a period or two later from when the revenue was actually recorded. And there are no attempts made to match the bad debt expense to the sales revenues in the income statement. The actual amounts of accounts receivables are shown to be theoretically fully collected on the balance sheet because there is no allowance account to take into account that some of those may not be. The use of the direct write-off method can reduce the usefulness of both the income statement and the balance sheet to outside users. And unless bad debt losses are insignificant, the direct write-off method is never acceptable for financial reporting purposes for companies that are underneath GAAP jurisdiction. Companies that are underneath GAAP jurisdiction have to use the allowance method for uncollectible accounts. This is the method of accounting for bad debt that involves estimating uncollectible accounts receivables at the end of each period. It provides better matching of expenses and revenues on the income statement and ensures that receivables are stated at their cash net realizable value on the balance sheet. So what we will actually be receiving these receivables are reduced by estimated uncollectible amounts on the balance sheet in the allowance method by using a valuation account which is the allowance for doubtful accounts, a contra asset to accounts receivable. So let's look at a recording of the allowance method. Hampson Furniture has credit sales of $1.2 million in 2017, of which $200,000 remains uncollected on December 31st. The credit manager estimates that $12,000 of the sales will prove uncollectible. We will have a bad debt expense of $12,000 for this year, and then we will recognize a reduction on our balance sheet to our accounts receivable through the allowance for doubtful accounts in the amount of $12,000. This on the balance sheet would be represented in this manner: $200,000 less $12,000, giving us net cash realizable value of $188,000. Therefore, when an individual looks at our balance sheet, they can say they actually really expect to realize $188,000. That is the true liquid amount of their accounts receivable. Now, at some point in time, we're going to realize which accounts are at Hampson Furniture are the ones that are actually not going to be collected. So the Vice President of Finance authorizes a write-off of a $500 balance owed by R.A. Ware. So we've determined that R.A. Ware is not going to pay this $500 balance. We reduce our allowance for doubtful accounts because we are recognizing 500 of this and allocating it to the accounts receivable for R.A. Ware of $500. Now, the net amount of our accounts receivable doesn't change. It's just where those amounts were at that changes. Let's assume that couple months have gone by and R.A. Ware has decided instead that they want to finally pay us that $500. Well, we have already written it off. So this creates a little bit of a conundrum in our books. What we have to do is we have to then reinstate the R.A. Ware accounts receivable and reinstate the $500 to the allowance for doubtful accounts. So what we have done here is we have reversed the original write-off entry. We would receive the cash, and then we would reduce R.A. Ware's accounts receivables. Just like the actual write-off, the recovery does nothing to the income statement. It just moves around the amounts on the balance sheet. Now, when we have estimations, we'll find in the notes to the financial statements what some of the aspects taken into account might be for those estimations when it comes to a specific company. With the allowance method, the estimation is really important because this matches our bad debt expense against revenues to the same accounting period. So let's just jump back a little bit and let's look at some of these accounts. Here we go. The allowance for doubtful accounts shows the estimated amount of claims that customers are expect to become uncollectible in the future. We don't know who, we don't know when, we just know that there's an amount that we expect based off historical experience. This credit balance in the allowance account will absorb the specific write-offs when they occur, as what happened in this exact slide. The bad debt expense is reported in the income statement as an operating expense, and this happens at the point of estimation, when we are writing off uncollectible accounts, such as the write-off of the $500 balance owed by R.A. Ware, this needs to be authorized for internal control purposes by management personnel, and that should be done in writing. Under the allowance method, every bad debt write-off is debited to the allowance account and then credited to the appropriate accounts receivable account. The write-off will affect only the balance sheet. Cash realizable value in the balance sheet actually does remain the same. With the recovery of an account, when the customer pays after the account has been written off, we have two entries. We have the reversing entry. So we are reinstating the original customer's account. And then we have the receipt of the cash and the satisfaction of the accounts receivable. Like the write-off of a bad debt, recovery only affects the balance sheet and has no impact on the income statement. Moving forward to talking about estimating the allowance. In real life, companies have to estimate the amount that they expect to be uncollectible using an allowance method. Frequently, this is estimated using the percentage of outstanding receivables or the percentage of receivables basis. To do this, management establishes a percentage relationship between the amount of receivables and the expected losses from uncollectible accounts. Companies often prepare a schedule in which the customer balances are classified by the length of time they have been unpaid. Because of the emphasis on time, this schedule is often called the aging schedule. And here's a representation of that. And the analysis of it is often called aging the accounts receivables. After the accounts are arranged by age, the expected bad debt losses are determined by applying percentages based on past experience to totals of each category. We see that right here. The estimated bad debts representing the existing customer claims expected to become collectible in the future. This amount so this total amount here represents the required balance in the allowance for doubtful accounts at the balance sheet date. Accordingly, the amount of the bad debt expense adjusting entry is the difference between whatever the required balance is and whatever the existing balance in that allowance account is. Occasionally, the allowance account will have a debit balance prior to adjustment because write-offs during the year exceeded the beginning balance in the account. If this happens, the debit balance is added to the required balance when the adjusting entry is made. So let's look at that in illustration. So let's assume the unadjusted trial balance shows the allowance for doubtful accounts with a credit balance of $528. So we have had prior period entries to estimate our bad debts expense. We've had some write-offs. And right now, $528 of what we had estimated has not gone through an actual write-off. They want us to prepare the adjusting entry, assuming $2,200 $28 is the estimate of the uncollectible receivables from the aging schedule. So if what we need the allowance for doubtful accounts to be is $2,228, but there's already $528 there, then we need to add $1,700 to that. We do that by having a $1,700 bad debt expense and $1,700 to our allowance for doubtful accounts. I'll leave this up here for just a second so you can see how notes to financial statements for actual companies are related to accounts receivables and the allowance for doubtful accounts, and how they go about reporting what they're expecting to happen and how they report what did happen. Now, realistically, because the allowance for doubtful accounts and the bad debt expense are based on management estimates, sometimes unethical managers may use this as what's called like a cookie jar allowance. And what they do is they would lower their estimate for their allowance for doubtful accounts or increase it depending upon those situations of what they need their earnings to represent. It would only be appropriate to lower your allowance for doubtful accounts as a percentage of receivables if your experience level is showing that is actually lowering, that people are paying more wisely, they're paying more timely, they are more mindful of paying. That is the only time that would be allowed. However, through earnings management, some companies have used these accounts. This is why when they go into audit, so the outside auditors are coming in, they really pay attention to accounts like this because they know that this is areas where there can be a little bit of fraudulent shenanigans occurring. We're going to look at another illustration on the bad debt expense from Brooks-Olk Company, who's been in business 5 years. Their unadjusted trial balance at the end of the current year shows they have an accounts receivable balance debit of $30,000. They had sales revenue of $180,000. And their allowance for doubtful accounts has a debit balance of $2,000. Remember, I told you that debit balance can happen. And what that means is that in that period, there have been more write-offs than the allowance estimation had in that period. So the actual write-offs have been higher. So bad debts are estimated to be 10% of receivables. 10% of $30,000 is $3,000. To bring our allowance for doubtful accounts to a credit balance of $3,000, we must credit it $5,000. So we have a bad debt expense of $5,000 and a credit to our allowance for doubtful accounts of $5,000.